All right. Good morning, everyone. I guess it's officially 8 o'clock. Welcome. Got a couple more people peeping in here. Carol, when you have a moment, would you go ahead and take the roll?
Yes, Mr. Jones. This meeting is being conducted as a virtual meeting, so I'll do a roll call of all the trustees to confirm attendance. Mr. Knox?
Morning, I'm here.
Mr. Bernstein?
I'm here.
Ms. Sanchez?
Here.
Mr. Green?
Here.
Chair Jones?
Present.
Mr. Santos?
Here.
Mr. Keough? Ms. Greenwood?
Good morning. I'm here too.
Thank you. Mr. Kelly? Staff participating in today's meeting include Principal Investment Officer Jim Rice, Investment Officers Amit Agril and Daniel Joy, Jeff Giller, Partner from Stepstone Real Estate Consultants, Margaret Knight, Partner, Tom Hessner, Managing Director, and Angela Ritchie, Principal. Trustees, if you have a comment or question on any item, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to please mute their mics until you're ready to speak. And now, Chair Jones, we may proceed with the agenda.
Okay. Again, welcome to everyone to the regular meeting here of the Real Assets Committee. Approval of the minutes.
Moved.
All right.
Second.
All right. Vote.
Right. Roll call. Mr. Jones,
Aye.
Mr. Knox,
Aye.
Mr. Bernstein,
Aye.
Ms. Sanchez.
Aye.
The motion carries unanimously with all trustees present.
Okay. Next item on the agenda is the report on closed session items. Let's see. Did we have any from those? I don't think I noted those.
No, we don't have any.
right.
The next item will be
Public comment.
non-consent item. Yes.
Okay. Oh, nope. I'm sorry. I'm looking at the wrong.
You're looking at the yeah, it's number 4, non-consent, the real estate co-investment secondaries recommendation.
I'm sorry. I was looking at the main agenda.
All right, are you ready for us to begin?
Yes.
Okay. So good morning, Mr. Chair, committee members, and other trustees. This item today is a discussion on the use of co-investment and secondaries in the real assets portfolio. We've prepared materials about the use of co-investments and secondaries to enhance our private real assets program. And as part of this, we've also included a recommendation for the committee to consider, which would advance to the board a delegation of authority to the CIO for certain co-invest or secondary transactions, which fall within certain defined parameters. So if we could advance to slide 4, please. I'd like to thank Ron Sankandwa, who volunteered today to have this invisible but important task of running the slides for the presentations today. So thank you, Ron. So this slide comes from our structure review, which was approved in November 19. This is the real asset structure review. To review what's occurred since then, we've made commitments to 5 closed-end infrastructure funds. And then later today at the board meeting, we're making a recommendation for our first open-ended core fund in infrastructure. Additionally, we're considering the launch of new investments in the private natural resource category, and staff expects to be making recommendations to the board in that area sometime this year. So those things are really covered in the first step of this structural diagram. And our focus today is on the second step here. We believe that co-invests and secondary structures will enable us to reduce fees, help build out a more diversified portfolio across vintage years, and also help construct a more intentional portfolio based on the sectors and geographies preferred by LACERA. So I'm going to turn the presentation over to Daniel Joy, who's going to describe some of the details about what we mean by co-invest and secondaries. Daniel?
Good morning, Chair and Trustees. Over the next couple of slides, I'm going to give a quick reminder of what co-investments and secondaries are. Ron, if you could move to the next slide, please. So on this slide, you can see the general structure of how we would invest in co-investments. Co-investment is the purchase of an interest in a company or in an asset, and mostly in the real assets world, that's an asset. So as you can see, LACERA buys directly into that entity, which then buys into the company, as opposed to buying into the fund. So it's still an asset held by the GP, but LACERA holds the asset outside of the fund. Moving on to the next slide, Ron, please. On the secondary side, it's a slightly different structure, since LACERA purchases the interest of another LP in a current fund. So as you can see on the slide, on the diagram, LACERA would purchase an interest in the fund from a third party that usually would be probably another pension fund or another institutional investor. Just bear in mind that when LACERA does this, they purchase not only interest, but also the undrawn commitments or the potential liabilities that arise from an LP interest, usually undrawn commitments. That's it for me.
Sorry, if we could move ahead one more slide, Ron, to slide 8. Yeah, thank you. So moving back to co-invest, why would we want to make co-investments? The main reason is that it enables us to create this more intentional portfolio that's focused on the sectors and geographies that best fit the overall objectives of our real assets program. It also allows us to build out our private allocation more quickly and replace some of the public market exposure that we currently have. Another important reason is fees. Often co-invests can be obtained at very favorable fees relative to general fund terms. Sometimes these are at no fee, no carry, which is the most desirable fee structure. These structures may also allow us to access assets that we would prefer to own, but without making a full fund commitment to other assets. I also want to point out that we have an active, long-standing co-invest program in private equity that we brought in-house to manage in recent years. We think this has been a success for LACERA, and our internal strength and what we have learned in this area should enable us to actually skip some of the steps LACERA previously used to obtain assets in this area, such as the use of a third-party manager to run a co-investment program for LACERA's real assets. So moving on to the next slide, Ron, on slide 9. So for secondaries, we see these as having benefits for LACERA, especially at the early stage of our private real asset program. One key benefit is that we can eliminate much of the blind pool risk that exists in a private closed-end fund structure, where you don't have visibility into what you're buying. In a case of a secondary, you often have very full visibility into the asset positions of an existing fund. There's also a benefit for us from diversifying the portfolio's vintage year risk by acquiring funds from earlier vintages. We can also mitigate some of the J-curve effect, which we face currently as we make significant closed-end fund commitments at a similar time. So when a fund is beginning to invest, the funds are subject to fees on committed capital before the capital is significantly deployed. And this has the effect of, these fees have the effect of bringing down internal rates of return for these funds and our private program as well, since our program has many of these funds at this early stage of their life as we begin investing privately. Secondaries would allow us to supplement our portfolio with additional mature fund assets that aren't subject to these same early fund effects. We'd also add that there's certain potential asset categories, or we may be able to acquire secondaries, particularly in certain categories, at a discount to NAV. And private equity is also involved in the secondaries market directly. Moving ahead one more slide. So while there's a number of benefits for incorporating these transactions into LACERA's portfolio, there's some elements that need to be considered, which we've highlighted on this slide. One very important aspect is the time frame needed to come to a decision, particularly on a co-invest. Often the time frame is not long enough to allow for a decision to be brought to an upcoming board meeting for approval. So that's why staff is proposing a delegation of authority for these transactions that meet certain defined parameters. Another element is the staffing we need to properly diligence and come to a decision on these transactions. Our real asset staff has grown from 1 staff member to 3 plus myself over the past year. And this has allowed us to have time to review these opportunities as they arise, in addition to the other work we're doing in the real assets portfolio. Another consideration that we note on this slide is there is the potential for concentration in a particular deal or asset that might occur if the deal positions are sized too large. We're proposing to mitigate some of that risk by limiting the size of a deal to so that LACERA's overall exposure is no more than 1/3 of an asset position to avoid this undue concentration. So moving forward, one more, thank you. So next we wanted to cover just the process that we intend to use to manage the flow associated with these investments. So I give credit to our private equity team for an earlier version of a slide that looked similar to this. And the focus here really is, finding deals that fit our objectives of our program, as represented by the strike zone. Examples for fit for the real assets program are really assets that are located in core developed geographies that have less, currency or economic risk. And we do prefer certain sectors of the infrastructure world focused on power, transportation, or telecom. Moving maybe onto the next slide, we've highlighted some of the elements of our due diligence process that we intend to follow for co-invests. It very much follows the process we have for existing funds with some additional aspects that relate specifically to co-invest. So we have a much more specific evaluation of the assets in a co-invest because we're focusing on just one particular asset. This would include the ESG components of that asset, as we do for fund investing. Our process would also include a review by our internal real assets investment group and approval by that group. And it would also require approval and sign off by our chief investment officer. Our process would also include a sign off by Alborn that they've reviewed and that we have followed the necessary diligence steps in our internal process. So moving on to our secondaries due diligence process, again, on slide 14. This process follows very much the process we used looking at funds, in that we evaluate the strength of the general partner, the fund terms that we would be exposed to. But in this case, we have much greater visibility into an actual investment portfolio. The process for secondaries would also include a similar internal approval process by our Real Assets Investment Group, or RAGE, and the CIO, and would also include evaluation analysis that would be provided by one of LACERA's secondary advisors. So LACERA retains a number of firms that came about as a result of an RFP that was launched a few years ago specifically for this purpose. So moving on 2 more slides to slide 16. We've set out the parameters we're looking to include in the staff delegated authority. First, we will confirm that the asset is one of the clearly defined asset categories for infrastructure listed on the slide, or one of the ones for natural resources. In this case, we've excluded oil and gas currently. We would most likely focus more in infrastructure on power, telecom, and transport. These fit most strongly with our asset class objectives of contracted cash flow, low correlation to GDP, and then also an inflation hedged component. In terms of geographies, we're focusing on the developed economies that provide the strongest legal framework for investors. On the next slide, as we launch into this program, We're focusing only on manager relationships where LACERA currently has an existing board approved manager or general partner. And when we say currently, we mean those managers that have been approved at the time we consider the investment. So this would also include any future managers that are approved later when we consider an investment, a co-invest or secondaries with that manager. We're limiting the size of a single transaction to no more than $50 million for a co-invest or secondaries transaction. And we're limiting the program overall to exposure of no more than $100 million annual amount cumulatively across both types of investments. And just keep in mind the relatively small size of this program relative to the pacing model for private markets that has us allocating over $2 billion annually across both infrastructure and natural resources in real assets. So on the next slide, we summarize all of the parameters we're proposing under this authority. Upon completion of a transaction, staff would notify the BOI in writing when these events occur. And we would also summarize annually the capital deployed under this authority as an annual update. On the next slide, we wanted to just lay out some of the parameters of this program, where if successful, we believe we would expect to come back to the board and committee for expanded authority in future years. That would open up somewhat some of the parameters we've established in the initial program. So we've laid out some of our thoughts about how we see this program potentially evolving in the future. And this would be done in conjunction with additional board review and oversight. And then lastly, on slide 20, we just summarize what we're asking for as part of the delegation for the committee to advance to the board. This would allow us, the staff, to begin the process of making smaller transactions in the area of co-invest and secondaries outlined on the parameters that we showed on slide 18. So with that, I'm happy to answer any questions at this time.
Actually, Jim, I have one to start out with. In the summary of due diligence processes for both the co-investment and the secondaries, I noticed in the co-investment, we did have an analysis of ESG and DEI considerations. And then in the secondaries, it wasn't there. Was that that intentional, or was that just an omission? Or is there something about secondaries that makes that more complicated from an analysis standpoint?
No, I would say that's part and parcel of any of these investments we would consider. We would do a full ESG evaluation of a secondary as well.
Okay.
I think just we were trying to highlight on the co-invest side, there may be specific ESG considerations for a particular asset that we might need to dig into more than what might be apparent from just an entire fund portfolio. But that absolutely would be part of either type of investment.
Yeah. I'm not seeing. Okay. Yes, Trustee Sanchez.
Yes, so Mr. Rice or Mr. LaJoy, I'm assuming that these guidelines are similar to the guidelines that we approved for private equity?
They're in some ways similar. They're similar in size to the first year of when the private equity program got started. Right now, the current authority is more expansive than what we have here, but this is similar, I would say, to what was established when we first took the program in-house.
Okay, thanks.
Chair Jones, I have a question.
Yes, Trustee Bernstein.
Mr. Rice, thank you for the presentation. It's all very interesting. I'm curious at the $100 million annual cap. It honestly seems like it gives us, the CIO, one bite at the apple in the year, which makes it hard to imagine even an approximation of a robust program. Is there a reason why it's so low? It seems to me that we do $100 million expenditures fairly regularly. I don't mean to minimize $100 million. It's a lot of money, but it's not a lot of data points in a year for us to evaluate how it's worked.
I think that's a fair comment. We do kind of view this as we look at, a lot of new areas that we're investing in as kind of, a crawl, walk, run type of scenario. So, we just think that, starting out with a program with maybe a smaller bite size just gives us more comfort. Should give everyone more comfort and the ability for us to evaluate the merits of the program at a later time to potentially expand it. So, I mean, I agree. We do think the co-invest deals in real assets are likely to be on average larger than what we might see in private equity, just given the nature of some of these assets. But we think it's enough to just get us started with a program that we could discuss further. Agree, we may not have a lot of data points, a year from now to discuss, but I think it should give us an idea of the types of opportunities that we've seen and said no to, and ones that hopefully we'd have the ability to execute on.
Mr. Chair, that's my only comment. I find our CIO prudent. I find our real estate team appropriately cautious. I don't think that given additional access to funding, they're going to rush to spend it. And I'm truly concerned that we're just not going to see enough with $100 million expenditure in a year to really evaluate how we want to go forward. So I think my recommendation would be to approve an authorization of something like 250 million, not an obligation to use it, but just have the flexibility to not be so constrained in choices.
Okay, so noted. Jonathan, did you want to provide any response or clarity to that?
Good morning, Mr. Chair. I think we were just trying to be cautious. And, when we started private equity, I believe, or co-investments internally, we started with a similar number. And I think what the data did show is that we were cautious. So I appreciate Mr. Bernstein's confidence. Regardless of what the allocation is, we will be cautious and prudent.
Okay.
As I know you would be.
Trustee Santos, I saw you appeared on the screen. Did you have a comment?
Yes, good morning. Thank you very much, Mr. Chairman. Yeah, I agree with Mr. Bernstein with regards to the amount. I think the program in the private equity program has been very successful. We get a full report from the consultant in addition to the report from the staff. So I will encourage my colleagues to increase the amount, or at least from someone in the committee to second Mr. Bernstein's motion. I think 250,000, million is appropriate.
I was going to ask if that was a motion. If so, I'll second.
Okay, that was how much you referred to the conversation. All right, so it sounds like it is a motion. It is a second. Do I provide for any additional comment about the motion, or do we go straight to the vote? Was there any other?
If there is comment, but I'm clearly supportive of it. So if Trustee Knox wants to be an outlier, here's his opportunity to jump in.
I'm just staying quiet because I talk all the rest of the day.
Well, I also share the same sentiments along with Herman, trustees Santos and Trustee Bernstein. Gina, or Trustee Sanchez, did you have anything else to add to that?
I just seconded it. I'm fine.
Okay, good. All right, so let's go ahead and take, without further ado, go ahead and take a vote. Carol, would you call the roll?
Yes, Mr. Knox,
Aye.
Mr. Bernstein,
Aye.
Ms. Sanchez,
Aye.
Mr. Jones.
Aye.
The motion carries unanimously with all trustees present.
All right. So then, next item on the agenda is the report that we have from the Stepstone team.
Okay. Are the Stepstone folks on? I have a, not sure I see.
I believe they are, Jim.
Yes,
Okay,
hi, this is Jeff Giller. I'm on. I think my colleagues are on as well.
Let me just introduce the item. So this item's an educational presentation being provided by LACERA's new real estate consultants, which is the Stepstone Real Estate Group. Well, we have three scheduled speakers. Margaret McKnight, who's a partner, Tom Hester, managing director. They're both based out of Stepstone's San Francisco office. We also have James Mena, an associate out of New York. LACERA staff's been working closely with Stepstone to bring them on board and supply them with the necessary information they need to analyze our portfolio and enable them to calculate performance of our portfolio. The team is just now digging into LACERA data, and we'll have some more specific recommendations and early conclusions to discuss in coming months. But for today's meeting, the Stepstone team's prepared today to discuss their view of some of the best practices in structuring and establishing investment processes for an institutional real estate program. So with that, I'm pleased to hand the presentation over to the folks from Stepstone. I think, is it Margaret that's starting?
Actually, Jeff is going to start off
Jeff,
for us.
okay.
I'm not sure I'm not showing up on the camera. Can everybody see and hear me?
Yes, so far.
Okay, all right, great. Well, thank you. Thanks for taking the time to listen to our presentation. Can you please switch to the first slide? Maybe one more. Just get right. There we go. I'm just going to give a brief introduction. Hi, I'm Jeff Geller. I head Stepstone Real Estate, and I think as indicated in the introduction, at this stage of the process, this is really meant to be educational rather than advisory. We have a lot of work to do before we actually start giving you advice, learning about your portfolio, its history, and the current assets and structures. So we're going to start that process with a top-down evaluation, so we can really ensure that we're addressing the goals, risks, and tolerances and sensitivities in your program. And as we conduct this evaluation and execute the strategic and tactical plan, we're going to make sure that we really focus on the resources you have, both the capabilities and the bandwidth of the resources, so that execution is as smooth as possible. We're also going to focus heavily on the size advantage. LACERA is a significant player in the market, and that kind of size comes with big advantages when you're going out and investing in different kinds of structures, whether it's fees or access. But that will be something that we really focus on as we do this sort of top-down analysis. And then we're going to end up delivering you kind of a set of guidelines for target exposures and different kinds of manager and vehicle structures that will be in the form of a strategic plan. And as part of that, that'll include an evaluation of your current versus your target portfolio exposures, are the ones that we recommend, to help formulate a transition plan between what you have now and where we think you should be, and sort of a gap analysis, if you will. And this is sort of the top-down aspect of our evaluation, and again, more strategically oriented. And we'll move from there to the tactical side. And the tactical side will really include a bottom-up analysis, where we assess what you currently have. We're going to look at your separate accounts, the different managers, the assets you have exposures to. And this is where I think Stepstone brings a lot of value, because we can bring in our active investment team, the team that actually buys, sells, and manages real estate through secondaries, co-investments, recapitalizations, and other structures, to knows assets very, very well. We'll bring that team in to mirror them with our consulting team to really help with that bottom-up evaluation. We'll also review commitments you have to funds and to see if they're appropriate, they give you the right kind of exposures. It's not impossible to reallocate exposures through secondary sales or other kinds of things that we can do to change weightings. And then at the end, we'll along with sort of the strategic plan, we'll have a detailed execution plan that will be married to the strategic plan. So if you will, the tactical plan and strategic plan. Tactical plan will follow the strategic plan we've done through the top-down analysis. So that's just a broad brush overview of what we expect to be focused on in the coming months. And that with that introduction and overlay, I will pass the baton to Tom or Margaret. One of you two.
Fantastic. Thanks, Jeff. Next slide, please. Thank you. Tom Hester, Managing Director, Stepstone Real Estate. I'm going to refer to my large screen over here. It's easier for me to see. So, this is a chart that we've all likely seen in some form before, but it's an important concept that we'll establish and we'll review as a baseline. The point here is that, unlike other asset classes, real estate has a lot of choices in terms of risk and return. LACERA has planned for core, value add, and opportunistic equity real estate investments. And the allocation to each from what we will be moving around over the longer term as those allocation targets are reestablished. Again, to summarize, core, the bottom left of the continuum, is typically high quality, well leased, well located assets performing at or near potential and usually held long-term for income. As we go up the risk curve, we add risk, but we lose income, while seeking an overall higher return driven by value appreciation or value enhancement and ultimately appreciation of the asset price and value. As we get into the non-core space, it's all about buying distressed assets and fixing them, broken assets and fixing them, or distressed capital structures and applying a remedy to those. There's more of a primer coming out on this later this summer, and we'll certainly share it with staff and the trustees, the white paper that Margaret and her team are preparing. But one thing to note, again, is that current income goes down as you move up the risk spectrum, which is what is contemplated, again, for the plan over the coming years. This provides, in our view, a more compelling case for adding commercial mortgage debt to enhance real estate income. We still need to learn a lot more about the plan's longer term needs for current income, but the point is that the market has grown dramatically post GFC private debt space, and these reasons may merit further consideration. Next slide, please. So I don't know if you, on that prior slide, if you were looking at some of the return targets, but what I want to point out by looking at this slide now is that over the past 20 years, and we'll focus on the chart, the table on the left, over the past 20 years, core has performed at just under the midpoint of its current target return range. Now, this period, this 20-year period, has been characterized by low and falling interest rates, so this makes some sense. But what's really interesting is that overall, non-core, if you look at the second line item, non-core real estate on the Burgess Index, 7.2% average return. If you look at overall the non-core, which is value and opportunistic risk categories, the return has not delivered at its projected returns, which are now in the 8 to 15% range. We will talk more about this later in this presentation, but the takeaway is that we are not in non-core with the expectation of earning a median return. We need to outperform, which is the goal, or you'd be better off sticking to core because, of course, there is more risk in non-core, and you're not going to get paid for that risk if you're just performing at the median. That said, now, if you look at the correlation matrix on the right, either way, you will be adding more diversification to your portfolio, and core and non-core are not altogether correlated much at all to the broader equity and bond markets. But given that your overall total real estate portfolio today, whereas of 12/31 is 79% core, 6% value add, 12% opportunistic, and there's a 3% bucket of credit. If you have a non-core benchmark, which is a core index, Odyssey, plus a spread, and right now we're using 100 to 300 basis points, you're applying that to 18% of your total portfolio, 6% value add and 12% opportunistic, you're going to have tracking error. So we are reviewing all the benchmarking right now. We have a ways to go on that, but we did want to call it out for this presentation. Next slide, please.
Hi, I'm Margaret McKnight. This page shows the pros and cons of the various structures available for private real estate. The 4 columns on the left address commingled structures, and the ones on the right are not commingled. So on the right, you both can and have to make the asset level decisions. 40 years ago, if you wanted to build a real estate portfolio, you had to accumulate direct property interest, and you could only operate on the right 2 columns. Since then, the commingled vehicles have emerged and have evolved to the point where they're very appealing choices. The commingled market has depth and it will work at your size. There are managers with proven track records. The commingled vehicles have 2 overriding benefits. Number 1 is diversification, and number 2 is accessing the focus of managers with significant market knowledge, depth, and comparative advantage, such that it's a positive to think that they're actually making the asset level decision. So let's talk about the risk return level and structure on the row on the top. Core real estate is income oriented. It's usually a buy and hold strategy. Of course, the portfolios are curated, but the idea is a long-term hold. These are best suited to the open-ended funds, which are like mutual funds. So you buy shares in a Vanguard stock fund, and Vanguard in turn buys the stocks. In this case, the manager is buying the properties. Now, the analogy breaks down in that with Vanguard, you could sell on demand in a close in a day. With the open-ended funds, you have you can trade on a quarterly basis, and it can take a couple quarters to move in or out if everyone else is moving in the same direction. But there is relative liquidity in the real estate world. Then we turn to non-core real estate, which is generally a buy, fix, and sell strategy. This is very well suited to the closed-ended funds, where you give a manager capital for a particular strategy. They have, say, 3 years to invest and then 5 to 7 years for the fix and sell. These can be very tactical. The big diversified managers are highly tactical within their portfolios, and there are specialized portfolios so that you can make the tactical decisions about which sector of the market to pursue. At this point, I'm going to pause. I wonder if you have any questions on this page. Okay, we'll move to the next page. Providing you a baseline portfolio as we go forward before we start talking about core and non-core in more detail. Your portfolio is $5.3 billion in real estate, market value at $331. It's 86% core, 12% non-core, and 2% debt, which I didn't break out on this page. 3/4 of it is in SMAs, directly owned assets, with slightly more fund use on the non-core side and more SMAs on the core side. In core, you have $3.7 billion or 81% SMAs. That's the lion's share of the portfolio. With that, we'll move on to talk about core. Core. Next page, please. There we go.
I'll take this one. Thank you, Margaret. I'm not going to spend a lot of time on this slide, but this is an Odyssey overview, and this is what we're trying to be. For those of you who may not be familiar with Odyssey, it stands for Open-End Diversified Core Equity, and it's a series of 26 open-ended funds that focus on core level risk. Often they have a small development component, but it's risk mitigated development strategies. You can see here that it's comprised of 26 funds, and the average fund is $9 billion of net asset value, 23% leverage, 115 properties, and 92% occupancy. So this is what we're trying to beat. And if you compare these stats here to LACERA's core separate account portfolios, they total in aggregate 70 properties, and we're indexing them to 3,000 properties in the Odyssey index. With the decision to add core funds going forward, you could have a portfolio if we redeploy capital into the Odyssey funds, that becomes more similar to Odyssey, particularly with regards to diversification, and will have significantly less tracking error. And Odyssey, again, is what we're attempting to beat. So with regards to the diversification wheels on the right, this represents what Odyssey currently is today. And this is what we will be focusing on. One of the factors we'll be focusing on as we evaluate LACERA's core asset accounts over the coming months. Next slide, please.
So as I noted previously, the vehicles have evolved. And they've evolved to the point where you can tap the power of diversification and actually start to invest in real estate more like you would approach your stock portfolios. On this slide, that shows the results of some work we did. We effectively did a Monte Carlo simulation, which is similar to what your generalist consultant would do to determine the overall asset allocations. We looked at 36 funds, including 23 of the 26 Odyssey funds, leaving out some chronic underperformers and adding in some adjacent core plus funds. We found that if you select 8 to 10 of these Odyssey funds for your portfolio, you can have extremely low tracking error. Now, you don't have a tracking error problem per se, as much as a return problem, but the implication with this strategy is that you are not likely to run at 2.8% underperformance, and actually quite far from it. Next page, please. There's ways to also outperform. At your size, you can pay lower fees than the average that's in the index, so that's a structural advantage. You can also manage your market exposures through fund selection. And the chart on the right side of the page indicates one way to do that. The dark bars are the Odyssey index exposures by property type. And the light bars are our current house views on what is likely to deliver better results on a going forward basis. You can actually change your portfolio faster than the index changes. This is still real estate, so picture an ocean liner and not a zippy little speedboat. Passive indexing pushes you into sectors that are less interesting, like office, which has been suffering systemic demand declines for 20 years. Work from home is just the latest blow in the series. There are also interesting new property types emerging that aren't in the core Odyssey funds, such as single family home rentals and data centers that you can gain exposure to through lower risk core plus funds. So it's interesting to add those core plus funds and these property types into the mix because of their attractive characteristics going forward. And then finally, I'll note that the Odyssey is a US index. Non-US core returns are as much as 200 basis points lower. So if you added non-US on the core portfolio, you would be going in the wrong direction on both returns and tracking error, though it would add diversification. We aren't likely to recommend non-core for clients like you in this situation. Non-US core. Before we move on to talk about non-core, does anybody have any questions about core?
I have a quick question.
Yes.
Things like data centers you mentioned, is that an industrial or other? And then what about, warehouses, which are growing by leaps and bounds in certain areas for the big companies?
Data centers is an other, and warehouses is part of industrial.
Industrial.
Okay.
Dominant share. And yes, industrial is rising, and we are recommending an overweight, and it sort of matches the underweight to retail.
What are some of the other areas of industrial that are growing?
So in general, industrial demand has historically tracked GDP growth, and there's been a huge shift towards 3PLs outsourcing on the client side. The cold storage has had a boom during the COVID period, and particularly both cold storage and many other kinds of storage as manufacturers switch from just-in-time to just-in-case storage. So that's lifted the base demand for warehouses, and the need has changed too. They're really functioning almost like factories to optimize throughput. And then the overlay on all of this that's really popped demand for industrial is the shift to e-commerce. So instead of going to the mall you push a button and something lands on your porch. That thing has to go to a warehouse and get sorted into a box to go to your house. So that's really the e-commerce has been driving the marginal demand for industrial.
Let me add a comment there to put it in some local context. Margaret's absolutely right. And, we all know, for example, the city of Commerce, appropriately named for a reason, long, major industrial and warehouse market, along with neighboring cities, Vernon and Bell. But there is institutional capital now trying to fulfill the last mile urban infill concept of distribution in places like Huntington Park and Southgate. An easy way to look at, so for example, once I had a summer job, once I worked at an Oshman Sporting Goods, 1/3 of the space in the Eagle Rock Mall was storefront and the 2/3 was warehouse, right? The storage room in the back of the store. Well, that concept doesn't, it's changed over the years. Now, in more cases, more frequently, we're seeing that storage room is now an urban infill location. And could be in any number of places in a large urban area like LA County.
Oshman's makes me feel nostalgic.
Yeah, I used to trade tennis rackets there.
Yep. Thank you.
Anything else on core?
I don't see any other questions in the queue. Margaret, if you'd like to proceed.
Okay, next page, please. We're going to talk about non-core. And Anya from our Frankfurt office is going to do that for us.
Thanks, Margaret. Hi, everyone. Let's talk about some important consideration in building a non-core portfolio. Slide 17, what we're really showing here is the number one item, why non-core manager selection actually matters. Looking at this chart here, you see that for every vintage year we're looking at here, return dispersion is quite high for all these funds, which really shows you that manager selection is extremely important. And as my colleague Tom had mentioned earlier, we're investing in non-core to drive returns. You don't want to walk out of this with mediocre returns. So in order to achieve that, you are best positioned if you're able to select first and second quartile managers. And just a note on what that means when I say selecting a manager, it's not just a manager name, a GP name. It is also things like market positioning, because with that GP, you're also sort of betting on a market to go into or certain property types that GP is playing in. So that just FYI, sort of when we're talking about manager selection. Slide number 18 is showing another key consideration on the non-core side. It's really, it requires a very thoughtful approach because it, after all, is a very large universe. In the US alone, looking at the last 5 years, you have close to 1,200 funds that's been raised. In Europe, close to 600 and so on. So a big universe that takes resources and efforts to really get to know them, to source those funds that are in market, and to make an evaluation. What you also see on this chart on the left-hand side is that the US is definitely still the biggest market, the deepest universe, and that is really because private equity real estate originated in the US. It's an approach, it's a mindset that was then later on transferred to Europe together with its structure. We've heard it earlier, typically non-core funds tend to invest using closed-ended structures. So that's something that's been growing in Europe, but it's also a market just like Asia that's quite a little bit behind the US in terms of development of the universe. In Asia overall, again, a growing market where we start to really see interesting opportunities, but overall fund sizes remain relatively small to date. And speaking of fund sizes, I'm moving over to the right-hand side. of the chart here, again, you see that the large majority of the global fund universe in the last 5 years has been with smaller funds below 500 million. And for such a large investor such as yourself, you might tend to want to focus on the larger funds. However, you would immediately decrease the investable universe for yourself. So, you know, while larger funds, there's nothing wrong with it. A lot of them have great returns. There may be value to be had from time to time by considering smaller managers as well. Moving on to the next slide here, in order to really implement a non-core portfolio, and this is not going to be new to anybody here, there's a number of considerations you really have to make, both on the portfolio level as well as on a more holistic level for LACERA. One of them, for example, being exposures. Where do you want to allocate your capital? Do you want to be globally invested, or could you also consider more dedicated, targeted real estate remits in, for example, specific locations? One of the things that's especially important in real estate and that managers benefit from is the local boots on the ground, right? You need to be ingrained with your networks in order to source opportunities, in order to execute. And that is something that the local boots on the ground really can do. And it's a certain expertise that you have to leverage really that informational advantage there. Property types, we already mentioned it. You know, do you want to be investing in the traditional property types where you already might have a lot of exposure in your core portfolio? Or would you maybe also consider adding alternative real estate property types to the non-core to complement that what you're doing in the core portfolio overall, such as, for example, student housing, senior housing, data centers, and some of the other more niche alternative real estate types. And then finally here on the exposures capital position, would you want to be just investing in equity, or would you also consider debt? Similarly, manager type is very important. You have those large funds, the broadly diversified full service with different teams that can work across sectors, across markets, across really the risk return spectrum, which works well for a lot of them. But there's also highly specialized funds out there that you may want to choose because they have a certain expertise in a dedicated niche market or niche property type. And then going further down here on the list, allocator versus operator, there's those funds that will allocate the fund's capital to different operating partners in their target markets, or would you want to stay with those that are operating the assets themselves? And then another debate where there's a lot of papers been written on is experienced managers versus emerging type managers. Experienced being those managers that have a long track record across market cycles, and emerging type managers, again, sometimes may be chosen because of a certain expertise they have in a market or specialized knowledge, but they may just be on their fund one or fund two, for example. And then fund type goes sort of hand in hand with some of the earlier comments on diversification, how they're positioning themselves, but there's those large diversified funds versus the focused ones again. What's the type of risk return level that you would want to add to your core allocations with this non-core portfolio? Tom has shown it earlier. If we're talking non-core, you're typically talking about value add and opportunistic funds. And again, within those strategies, there's different risk return levels. And then the specific strategies pursued. Other considerations, I'm not going to go through it in detail because I'm sure some of these or most of these probably are the same in other asset classes, but things to consider is just your own resource planning, potential capacity constraints that there may be, higher level goals, such as are there strategic partnerships, for example, that you want to strengthen. ESG, we know, is a very important topic to come into play, and then performance goals. And taking all of that together in the end is going to really inform the manager structures you'll be using, the commitment sizes for each of those managers and their funds, and the nature of the strategies pursued. And then once you have that, you can really go into sort of cash flow modeling and pacing tools that allow you to build and hopefully maintain your target exposure for the longer term. So with that, we're concluding our prepared remarks, but again, happy to take any questions.
Trustee Bernstein, I see you popped on. Do you have a question?
I have a comment. I'll wait till we get to that part. I don't have a question. I thank you
Okay.
for the presentations.
All right, I don't see any questions. Would you like to go ahead and make your comment then?
So my comment actually, as it occurs to me, is more of a question maybe for John and staff. I'm well trained at this point in strategic asset allocation. Real assets is part of that, and then breaking it down into different categories is part of that. But as much as the numbers are compelling here, I have to say at a certain point, it feels like every time we divide into smaller and smaller, more managed things, we're inherently assuming that we're going to be paying for more of that. And now we're looking at funds that are mingled from many asset quality categories. And so I guess my question for John is, it's sort of a balance of strategic asset allocation. At what point do we start to see dwindling returns from strategic asset allocation? Would we be better to simply buy office buildings and multifamily and single family homes and agriculture? Do we truly benefit from going down this path of funds that are composites of multiple categories?
Thank you, Mr. Bernstein, for the question. I certainly believe in diversification. That's an investment belief. I also take your point and agree with it that diversification in name only or over diversification in effect gives you index-like performance with higher fees. So I think that it's a delicate balance as it relates to real estate in particular. We've had a not a diversified portfolio. We've had a very lumpy portfolio with much single asset risk, and several of those assets have had dramatic underperformance. And as a result, our entire real estate portfolio over the last decade, Margaret used the figure of about 200 basis points. We've underperformed our benchmark by 180 plus basis points annualized over the last decade. So I think that what we need to do is reimagine, reinvent our portfolio and no longer have it constructed based upon a framework established 30, 40 years ago. Because the market's evolved, there are easier ways to get that beta exposure. And I agree with the core of the question. I think that we should have a combination of structures. We should have the core. It's really hard to outperform core. We can get that exposure maybe through some Odyssey funds. Maybe we complement that with some separate account exposure, combined maybe with some joint ventures, co-investment. I think that we should be expansive and be compensated for the risks that we take. Because I think in many cases, we've taken operational risks that we haven't been compensated for and single asset risks that have not inured to the benefit of our performance.
Okay.
Would you mind if I add a comment on the diversification issue question?
Yes, go ahead, Jeff.
Thanks. I think it's a great point. But I think one thing important to understand is that the managers that we're selecting in the non-core space, they're not really seeking diversification for the benefit of diversification. They're trying to be, what they're attempting to do is be very precise and very tactical about achieving the best risk-adjusted returns. And that might mean they overweight to office and underweight to industrial or any combination of things. So what they're not attempting to do is to build diversified portfolios just for the sake of diversification. They're trying to maximize returns. So so they're doing what maybe you suggest we do, which is going into the right assets at the right time, tactically, and that's how we expect them to outperform. I just wanted to make that point.
All right, thank you, Jeff. Trustee Sanchez.
I would also add to the conversation that it is also possible to be too concentrated. And although we have a very large portfolio, there was a very great article that was published in Institutional Investor just recently that sort of highlights the fact that when you go into these private structures, more often than not, you actually take, unless you kind of take a larger portfolio approach, you can end up with some very serious concentrations, even though it seems like you're diversified. It is a very fine line and one that we have to kind of think about. So I appreciate the conversation and the comments, and I think they're all valid. But I just want to make sure that we remember that there are multiple perspectives. Thanks.
And Chair Jones, I did have one more comment.
Yes, go ahead, Trustee Bernstein.
Yeah, it's just, it's about the ESG aspect, and having now chaired our corporate governance for 3 years, we primarily talk about things like human capital and board diversity, very important topics. I would just encourage us here, considering how old guard climate change is for ESG and how ascendant it still is in the European conversation, when we're starting to touch on things that incorporate things like potentially, agriculture or timberland for carbon credits, looking at regenerative farming as an economic model, those are significant parts of the ESG conversation around carbon. And I would just encourage staff and encourage StepStone to look for opportunities to do a little bit more than just give sort of a nod to and ESG. I think that's a part of the conversation moving forward. We haven't met here in a while that we could begin to expand a little bit more robustly.
John, you got a comment?
Yes, and once again, thank you, Mr. Bernstein, for the comment. One of the things that I think we flagged for the BOI, and we can provide more detail over time, is in real estate. We've been working with our partners with GRESB, which is ESG oriented reporting, GRESB, and it's something that we are in effect mandating that our real estate partners report on in order to have better information about the sustainability of our real estate portfolio. But the point about the broader real assets, absolutely. We view ESG as a critical aspect of all our diligence across all asset categories.
Great. And I don't remember exactly how it falls into Tide. I just, it's not a criticism of today. It's just a suggestion for how to make the conversation more robust moving forward.
Got it. Are there any other questions for the StepStone team? I want to be mindful of the fact that we're right at 9 o'clock and that piece it. All right, there being no further questions, I don't know that there's do we need a motion to accept the presentation, or do we just kind of move on to the
we can move on.
Okay, all right. So then go to the order is the last thing we got.
We have items for staff review, but we don't have any. And now we can do the good of the order. Would you like me to do the roll call?
Yeah, we would.
Okay. Mr. Knox?
It's 9:03. We will start BOI at 9:10.
Thank you. Mr. Bernstein?
Nice to see our new guy stepping up and leading. Good job, Chair Jones.
Yeah, great job. Ms. Sanchez?
Yes, so great job, Patrick, and welcome to StepStone. We look forward to working with you.
Mr. Green?
Good job, Chair Jones.
Mr. Santos?
Yes, thank you very much for the presentation, StepStone team. Just a general comment, Mr. Grable, you have heard my comments before about my reservations about this, the real estate portfolio. So I'm looking forward to the implementation of the plan that was discussed today. As it was stated, we have been underperforming this particular portfolio for the past 10 years. It's something that, Mr. Grable, at some point, I will respectfully request that we do a deep dive as to what went wrong so that way we can learn. It's not about blaming, it's more about what we can learn what mistakes were made and how we can correct them. So that way this particular portfolio can perform to the highest standards as the other asset classes is doing. So thank you.
Ms. Greenwood? Chair Jones?
Yeah, thank you for the modest amount of hazing for my first event here. I do thank you, Carol, very much for your support. Jim and your team and the real estate, we were in the presentation you gave, and in Stepstone, we're excited. I think John said it perfectly. This is a great opportunity to kind of reimagine what we can do kind of going forward on behalf of our members. So with that being further said, and to cut into any further time of the 9:10 estimated start for the board meeting, meeting's adjourned.
Thank you.